particular clause would need some clarity, I think, because the report says personal guarantee is a must.
Because many of the bigger units, they come out as SPV. Now, SPV is a contribution by the parent company and different joint venture partners. In that case, and there also in this Mahapatra committee recommendation, another issue is that this corporate guarantee is not a substitution for the personal guarantee. So that way it needs clarity and needs clarification.
It may be a speed breaker. I mean,
yes,
personally, I feel it may be a speed breaker in many ways.
Clarified. But I think we should understand the underlying purpose, the personal guarantee, that this restructuring should not be taken just as a, you can say, escape route. From that point of view, this is being brought in, but it should be brought in with some little cautions.
Another large question. It is felt by many in the banking system that, this CDR mechanism is being taken as one opportunity given to a company to clean up everything, whatever are their past sins. See, due to poor financial planning, we have come across, many corporates who had raised debts when they were able to. In fact, there are instances where the banks were ever willing to give them money because of the name, because of the hype. And they structured in many ways to give the loan. For example, they will give a loan against shares, and the money goes for investing in an SPV, as he says. And when there is a downturn, all these come to the surface. One may even call this corporate adventure. Should the system pay a price for such a corporate adventure? Or should we remove it from the CDR mechanism and do it separately elsewhere, this one? What's your view on this, Mr. Anthony?
I don't know, I have a different view on this actually. Project appraisal by a bank, when I was an appraising officer. What is a project appraisal? Appraisal is a review of the project report done by a promoter. A promoter, maybe in consultation with an advisor, he prepares a project report, and bankers' responsibility to appraise that. And if you get convinced, you sanction or not that loan, right? So a review is done. So I'm not sure whether Mr. Chakravarti, Dr. Chakravarti has been emphasizing on this point that appraisal standards have come down. I think we should focus on that aspect now. I think project
appraisal will take care of this.
Yes, I think appraisal standards have to be. I mean, it's a difficult area because earlier term lenders and working capital bankers were distinguished. Distinctly, they were different, and term lenders had appraisal capability. Now there is no distinction. Now all are bankers. There are no separate institutions. Bankers, of course, when it becomes a commercial bank, I mean, they are looking at various, their responsibility widens. In fact, they become more commercial in nature. So appraisal definitely has taken a back seat. That's what is my view. That's why larger projects, many of them. In fact, I'm tempted to mention one particular case done in CDR. I will not mention the name. It's a large cement project, but it was done in CDR. I was really surprised to see the project needed another 150 crore for completing the project. It's a last mile completion project. CDR restructured the loan, existing loan, and asked the promoter to raise 150 crore from outside. I mean, according to me, it's a case not to be done in CDR. I mean, it's not viable. I mean, if the promoter can raise 150 crore outside, I mean, he would not have come to CDR. I don't know. Anyway, the appraisal standard, of course, needs.
That is the need of the hour. The appraisal standards have to be increased. If the appraisal standard is increased, then I am sure that banks also would not have, structured in many ways to give corporate loans to many of these clients. Yes, sir.
This appraisal standards which need to be improved, certainly there is a need for it. But at the same time, there is a definite need for improving the monitoring standards also. Post-appraisal, if things are not moving according to the appraisal assumptions, if it is because of the circumstances which are beyond the control of the entrepreneur, fine, it is understandable. But if it is because of the circumstances which are created by the entrepreneurs, it needs to be monitored carefully, and their appraisal need not to be blamed.
We can do it at the end, sir. Um, we have discussed the larger issues. Now let us go into some of the operational issues. One operational issue which perhaps poses a potential threat to restructuring under CDR in my view is the insistence of bankers to keep the account standard during the time when the account is in CDR. They want him to pay the interest on installments. This creates a more cash crunch, over and above the cash crunch which is already facing. The bank's insistence is because they want to, see that the quarter end, supposing there is 31st March or 30th June or 30th September or 31st December comes in this period when an account is in CDR, they will say somehow we keep it standard, I don't care what do you do. Even though the provision says that once the account is restructured and implemented, you can go back to the original status, which could be standard. There is a provision in the intercreditor agreement which provides for a legal position in the sense, any debt is valid for 3 years unless the debtor acknowledges. So it has been provided for in the debtor-creditor agreement. That limitation clause gets automatically abated during the period when a company is in CDR. The bankers have taken care of themselves. They said during this period will not be counted for the purpose of the 3 years. This is because in many cases, the companies also play hide and seek with the bank. They would avoid signing the acknowledgement of debt and security. They will keep it to the last minute. This is recognized in the CDR circular itself. Just as it is abated in the case of this limitation, can we abate this classification during this period? It is a bigger concession which I am posing to the panelists. On the other hand, the Mahabhadra committee says the other way, exactly the other way. They are making it more stringent, saying that this regulatory forbearance shall be removed. About which Mr. Chakravarti, they are doing their job, the regulators. He gave the answer also. When some of you asked, he gave the answer saying that, look, you downgrade the account and do whatever you want because you have built the cat, you have taken the asset in your books. You deal with it anyway. You make 25%, he said. You make 25% and then do restructuring whatever way you want. Anyway, this suggestion, I do not know whether it will be a very practical suggestion in my view, but may not fit the regulatory wish. Another operational matter is this. Possibly this is where the CDR became I would not like to use it, but a less serious matter. When the original circular was issued in August, the circular very clearly envisages EDs of banks should preferably attend. This is what they said. The CDR EG meeting itself, empowered group meeting itself. They said senior level also they added, or an officer who is properly authorized by the board of the bank to commit the bank. But we don't see this commitment taking place in many of these meetings. But in their wisdom, the CDR also has provided a cushion period. At the time of admitting, supposing there are banks which say we have no mandate, because the head office has not advised them what stand they should take in the meeting. So they say no mandate. This becomes a very difficult period for the corporates to manage. I am talking in practical terms. In this period between one CDR EG meeting and the other CDR EG meeting, say there is a period of 1 month. In this 1 month, the customer has to go to the bank concerned and convince them and get an approval because the minutes of the previous meeting will be confirmed only in the next meeting. So before that, if you can get their approval, it is counted for the purpose of the supermajority. It is an arduous process. Instead of that, can the banks act a little more quickly? To say it is a problem faced by the banks also. Can the banks, act more quickly to give a clear direction to the company? It calls for once again an attitudinal, a setup should be there in the banks. There is a need to sensitize people. Do you think a day will come when this will happen? Because we find no mandate banks have increased in the CDR. This is the general experience of many. Yeah, please, Mr. Anthony.
In fact, this is where fine-tuning of process of CDR. I would like to suggest one thing, Mr. Perhaps Sandra Kumar can react on that. This no mandate, why it's coming no mandate? CDR is a two-stage process. First stage, it's an admission. Second time, it is the approval of the final package. Now, somehow in the wisdom in CDR, it was suggested that even at the admittance stage itself, there should be a scheme. There has to be a proposal. Now, this is, according to my personal experience, is that when there is a scheme, this needs an approval of the topmost authority, competent authority of the bank. My suggestion would be remove that. For admittance, it has to be only yes or no. It should be a one-page flash saying that this company needs restructuring. Okay, yes or no, this only bank should give, and it should be given at the meeting itself. Because if there is a scheme, it has to go to the competent authority. Competent authority will sanction, then it will be communicated. Then during the course of finalization, there will be some changes. Again, it has to go to because the final scheme is something different. It has to go again. I mean, it takes a lot of time. Two things what consumes time. As Chakravarti agreed, time is essence. In a restructuring, time is essence. So at the flash stage, it should be only one page saying that what has been the experience of banks with this customer. Last 10 years, how has he done well? If he has done well, I think he should be given a chance, yes or no. If it is a no, I think, as you correctly said, no senior level participation happens in empowered group, except SBI, IDBI or ICICI. There is no other senior level participation. The best thing would be, if a bank is disagreeing to restructure, that is, answer is no, the ED of the bank should give in writing for the reasons for that. I think this suggestion is my suggestion, which I would be making to Reserve Bank in respect of these draft committee reports. I don't know, Sandra Kumar, how do you react to this?
No, flash report, I do agree with you, but the fact remains that even assuming that an ED level person goes for the CDR EG meeting, for example, in State Bank of India, CGM, which is equivalent to an ED in any other bank, he attends. But even he cannot give the mandate because the actual appraisal or the scheme has to be approved by a committee. So the CDR stand has to be approved by a committee, only then. So the individual is not authorized to agree to the mandate. You wanted to say something?
No, that is why it is said, the board shall authorize the officer concerned to commit the bank. That is the original instruction of Reserve Bank in 2001. My point is that is getting diluted slowly because of this internal, delegation of powers which each bank has. It is getting delegated, and that adds to the delay, and that adds to situations like this when there is no mandate.
Yeah, but having said that, I must also say on occasions when the officer who is representing the bank was not aware, he has talked to the group executive and orally consulted him and has given the mandate. It has happened also. But as far as the suggestions, I think being a member of the core group, I think I will not comment anything now, but I can next step take it up. Maybe the bank should represent if they feel this is worth it. Yeah. Everybody can, or maybe when you minute these meetings, maybe a representation can be made and the CDR core group can have a look at it, examine it.
Mr. Sanger?
I would like to supplement it with one more thing, that it's at the time of the admission, of course it's not a very, very complicated decision to take. But normally what happens, when it comes to the admission stage, the member bank's intimation will come just at the last moment. Tomorrow is the meeting, today the party will come running that tomorrow I am going to CDR platform, kindly support me, my case should be admitted. That is, I think, where the problem comes. Similarly, in case of final approval also, appraising agency appraisal note will come just 2 days before that. Now, at one point of time, we are talking that whenever we are talking about any of the appraisal, may it be for the restructuring or for the initial, it should be a well thought of appraisal. If you are giving it just 2 days before the meeting date when it is there, where is the time for the lender to actually go through it? And in fact, in the last CDR meeting, my bank's representative has given a suggestion also. There should be at least a 15 days time once the appraisal given by the main appraising authority is given to the lenders. They should be given time to think over it and form their view and have a proper assessment of it. Not that just 2 days before that this report is handed over to the lender and then you expect that you give your mandate.
Absolutely. Very correctly said, but a suggestion comes to my mind saying that could there be, that the escalation matrix for this restructuring could be speedier, faster than a project finance proposal which comes within the bank.
No,
you correctly said because of the 90 day, 60 days, 90 days.
For the major cases.
So I think the escalation matrix should match these, time stipulations made in the CDR.
That has to be, but that can match provided proper time is given to think over it. And internal procedures, of course, it should be, you can say, hastened up. But at the same time, there should be bare minimum time which should be available to put it to the competent authority with the proper appraisal. That has to be there.
As Mr. C.B. Antony said, the detailed appraisal, he feels that could be done at the later stage when the final approval for the package is given. But as far as the admission stage is concerned, a very preliminary proposal of the proposal should enable the banks to give a yes or a no. Okay. Another major operational issue, which I think he also mentioned, additional funding. Some of the banks, in spite of very clear instructions in the CDR circular, opt out of additional funding. Many cases. When they come to the CDR also, they say, restructuring fine, no additional funding. And in CDR also, there is a practice of voting issue by issue. When you complicate the process by calling for voting on issue by issue, all these questions will come. So, my suggestion would be that, yes, it is a general suggestion which we have felt out to many clients, saying that what is being approved is an overall restructuring, no specific issues. We agree to restructure. If additional funding is called for, it should become additional funding many times turns out to be the lifesaver for the institution. If not provided at the right time, it could kill the industry also. So this additional funding, why the banks generally have a hesitation to commit, in spite of the fact that there is a regulatory forbearance for this additional funding. They need not have to, treat it as, downgraded. How to overcome this, mental block?
I don't really have any statistics on, what is the percentage of cases where banks have said no additional funding. And I think each bank has takes its own view. And by and large, I have a feeling it could be because in some cases, there are banks which do not support the CDR. They don't go along with the other banks, and simply because of supermajority when it is thrust on them. That is when I think a bank says, I will not participate in the additional funding. Which I think that if a bank is not supporting the CDR itself, that means they have their own reasons to believe why the CDR should not be supported. So when it is thrust on them, naturally they have reasons why they won't commit more money into this. So I suppose that could be that.
We'll keep the question and answer to that. We'll take it up in the next question and answer session. Okay. The question is, we approve a package. Okay. We approve a package which includes an additional funding. My point is, when you approve the package, you have put it to vote. They said we approve the package. Why this conditionality of additional funding? Why issue by issue voting? About release of some security. Issue by issue voting, if it is done away with, perhaps it could expedite the process. It is a yes or no only. It is a yes or no. If you say it is, I am not for additional funding, it amounts to a no. It amounts to a no. Because without the additional funding, it is not viable. That is what is recognized by the, whoever has appraised. The monitoring committee appraises us and finds that it is viable with additional funding. The package becomes meaningless. So I think this is one area where I sincerely feel that banks have to have a relook, and possibly when they don't feel comfortable with additional funding, they should have the guts to say no to the package.
Where you can say the interest of each one of the lender as well as the borrower is taken care of it. Lenders will not have any objection to agree for the additional funding because that is for the survival of the unit. But if the package is not convincing for the reasons I may not like to discuss, I think then this kind of issues comes.
Then it is a no. It becomes a no. Instantly it becomes.
But many times because
The
of
bank
super
may say
majority,
no, but it will
because
be
super
thrust on
majority
the
you can't say no.
majority, no?
Who is thrusting?
I mean, that's what happens.
How does that
No,
issue
no,
also?
That's the
if
reason.
75, more than 75% agree, then
I said that it should be a convincing package for everyone.
Okay.
I think then there will be no hesitation.
no, ultimately it boils down to that.
Another one of the major thorns in this process is what is known as the holding on operation. I think holding on operation is a very, very important period in the life of a company because that is when it requires oxygen. Holding on operation commences the moment he comes to the CDR, and during the period it is in CDR. The CDR, on admission, the CDR issues a circular, now you can begin holding on operations. But we find it rarely happening. And the holding on operation instructions are so broad. I think CDR has given everything in its circular. It has given a lot of flexibility in terms of timing, aiming. And one such flexibility it has given is the fact that in addition, the holding on operation, it goes by the aggregate, fund-based and non-fund-based. That aggregate shall be protected. Even the fund-based can be taken as non-fund-based, and non-fund-based can be taken as fund-based to the extent he repays during this holding on period. In this period, if he pays 1 crore, he can take it as a guarantee. The sanctity of the limits go away. It's a wonderful instruction, I think, in order to keep really viable units on oxygen until the CDR process is this thing. But we find this not happening frequently in many companies. In fact, holding on operation, by the time they decide on the modus operandi, 3 months are over, the package is ready for approval. This is a practical situation. How to make the bankers agree to this holding on operation? In spite of instructions, they don't do that. Did it happen in your case, Mr. Sundar? Was there any holding on operation?
We had some initial difficulty, but since the monitoring institution was the lead banker, and they had a clear direction, and based on that, some flexibility was given to the company.
Zanga?
I don't think there's any issue in that because we do allow the operations for the convenience of the unit because ultimately it is, again I'm saying, for the survival of the unit. And moreover, after the implementation of the package, it retrieves back to the original asset classification. So
there should not be any hesitation.
Yes, there should not be any hesitation, and normally we permit it.
The general feeling is
And
that I think that down the line, the sensitization.
One of the CDR members sitting here with us also can vouch for it. And one of the corporate also, which has been restructured, can vouch for it.
The issue is, there will always be some irregularity in the working capital, which is being converted into WCTL. Once it becomes WCTL, there are a lot of issues around that. Now, WCTL should be secured. Till that is done, holding operation doesn't come. I mean, there is an issue in CDR, which needs to be, fine-tuning is very important. There needs to be a fine-tuning.
I think when a bank agrees to a CDR restructuring, then we are going with our eyes open. We have done the viability study, we have accepted it, we know the unit will be able to get back on its feet, that's why we are doing it. And so, I think there's no reason why any bank should delay the holding on operations. At least I have not come across such instances. Possibly there are some experiences.
There are quite a number of instances. That is why possibly once again that sensitizing the lower level officers will be necessary. These are some of the operational issues which many clients have sort of reported to us. That's why we thought it is a good forum to discuss.
One more operational issue which banks should look at for expediting. Again, time is the essence in any restructured assets. My suggestion would be, there is a tendency to ask for a TEV for every case. I mean, even a case which has been with the lender for 10 years, 15 years, performing well, When it goes to CDR, there is a tendency to ask for a TEV. My experience, which I am saying. In fact, I have resisted in many cases. When the company was doing well till yesterday, why do you need a TEV just to delay the process? My suggestion, as I said, it should be yes or no at the flash. Next 3 months, banks should work on the only consortium meetings and finalize the package. If you want a TEV during that period, get it done. Shorten the period of restructuring. It should not exceed more than 3 years, 3 months.
3 months. Another larger issue, possibly the final issue which I have. We all understand what is a simple restructuring and what is a deep restructuring, as we call it. A simple restructuring would mean simply postponing the repayment obligations, interest and installments. It will mean a simple restructuring without any interest on them. And a deep restructuring may require write-off of a debt because the company has contracted more debt than it could serve in a reasonable time, as brought out in the projections. Or a portion of the loan may have to be converted into equity or zero coupon bonds. There are so many instruments to which we can convert this, in which case there is a real hit on the banking system. So can we remove the simple restructuring cases to another unit within the CDR so that it can take place faster? What is all required is wait, I will pay. This is what the customer says. If this could be done more expeditiously, it will give you a lot of breather to, especially the smaller units, which we are emphasizing in this forum. This can be done very quickly in a quicker setup, as I said, a nimble-footed setup, while this deep restructuring, which will be, I am sure, will be in the case of bigger units, because in the case of smaller units, conversion into equity may not happen. Whether this could be only, done with the participation of higher level officials who can commit the bank to such initiatives as, issuance of equity in exchange for debt and all that. Will this suggestion work? And I personally feel that it should work, but we should have proper setup. Mr. Anthony, we can go on suggesting, right?
No. See, the CDR, one of the issues faced by the banks is the CVC. Let's be very clear on that. It's an open forum, I thought I could speak, because I also was part of a public sector bank. CVC is a major issue. Why the cases are referred to CDR? Though it's an informal group, it's a forum where things are discussed and restructured. When it is done outside in a privately, 3 banks sit together and do, that could be, it's the mentality, it's an attitude. So I think the CVC issue has a lot of ramifications on the working of the banks, public sector banks. So a forum like this, if it is restructured under that, discussed in the presence of so many, there are 3 standing committees, standing members, the lenders, all that, it gives some credence. That's why perhaps the lenders would like it to be referred to CDR. That's what at least some bankers told me.
These are 2 incentives. There are 2 incentives as clearly mentioned by you. One is the CVC bogey is not there on the officers. The other is, as I told you, the incentive is abating the downgrading of the account. These 2 incentives should make banks bring more and more cases to CDR. But whether we see it happening is once again an issue to be debated.
CDR should be used as a forum for that kind of a protection,
That should not be.
Because I came across 1 or 2 instances where, it was a decision which was to be taken in the joint lenders meeting.
Excellent.
And it should not be brought to the CDR simply because I want a CDR stamp on it, therefore, tomorrow CVC cannot ask me any question. I don't think the CDR forum should be used for protection from possible CVC action. I think what has been laid down, what should come to CDR, only should come to CDR. And as far as what you said earlier also, you had mentioned that it is an incentive from downgrading of the account, but it can work the other way also. That is, I think, precisely what the regulator is concerned about. The incentive perhaps should not be used in a negative
manner.
Indiscreet manner. So I think.
In fact, one of the good suggestions of the draft committee is that remove the incentive.
I think ultimately it is left to the bankers to take a very concrete view, a constructive view, objective view on whether this unit needs restructuring, and based on the viability and based on the information they have, the relationship, I think they'll have to take the call, but not because it is an incentive against downgrading of the asset. Even if it means it's going to be downgraded before the whole process gets completed or in the meantime, I think bankers, if I am concerned and if I want the unit to be restricted, I do it even if it is an NPA. Why should I do it only if it is a standard asset? I think bankers should take that view and not use CDR as a forum for that. I don't think it was created for that.
I think I come to the end of the questions which I have, unless the members want to address on specific issues, any specific issue. We can now take the questions from the
one specific issue which I would urge on the CDR system, because Sundara Kumar and all, today they look at CDR in a very intense manner. One is the recompense issue. This has been again one of the contentious issues of CDR. What is the recompense? As I see it, the recompense should be the loss made by a bank is to be recouped by the lender, by the borrower. That should be a recompense according to me. And the regulator, in fact, regulator's role, one of the roles is that, as I said, remove the incentive of that, keeping the asset classification. Second should be ask all the banks to cooperate with it. Then recompense. Regulator has very clearly laid down that what is the loss to the bank in the value diminution of the loan. That is the loss to the bank. In a restructuring, value diminution of the loan is the loss to the bank, which has been provided in the P&L of the bank. It's very clear instructions from the regulator. And that should be, every year it has to be done and calculated and provided. And according to me, that should be recompensated by the borrower when he does well. And maybe at a compounding interest rate, that's fine. But leaving the recompense clauses as vague as what is now, even prevents even private equity guys. Some of the distressed asset investment bankers are there. They would like to take on some of the assets. They are shy of coming in because of this particular sort of democracy, like the company shall recompense, because it's vague. One really doesn't know what is the amount of recompense this company will have to pay when it becomes healthy. Perhaps we need to be a little more objective on putting that recompense clause. And I was really surprised to see the draft recommendations. The bank should be flexible. The word used is flexible. And it says it should be 100% or 75%. I don't know what is flexibility means.
This is the problem. It has been put in a straitjacket. 75% is the minimum. Now, if it is 70%, are we going to say no for the lack of that 5%? This is why how the regulations can work against, the.
In fact, I would like to be educated on that. If you can elaborate on that. The diminution of the loan value is to be provided in the balance sheet. It's very clear, very objective, and every year we are provided in the P&L of the bank. Why can't we aggregate that on a compounded interest basis for the recompense? Very clear objective.
I think working group has also talked about it and about the exact way the diminution.
Anyway, I think we should know.
The word used is should. 75% should be.
Has given these guidelines also in this committee recommendation, but it still needs a little more clarity. Reason being, I'm telling you that when we go across the process of this restructuring and providing for on the NPV diminution basis, the years which have passed on, for that, whatever the hit is there, that has already been taken by the bank on its balance sheet. But it is expected that this provisioning should be made for the entire period. So this kind of small issues are there, which needs to be addressed properly, and some proper guidelines are, I think, further need to be streamlined on that.
Yesterday, I think there was a meeting with the IBA, and all the banks have met and submitted their views on it.
Okay.
So I think we'll have to wait and see, because the Mahapatra committee recommendations are still in the discussion stage. maybe we'll have to wait and see what the final.
Been invited, and I think.
And the only point which I am making is putting this, in a straight jacket. 75% should be, in any case, should be insisted upon. That takes away, opportunities where supposing somebody is willing to pay 70%. If you say no, then there will be a real problem. Then it brings accountability also. I think they should rather attack the problem by giving a formula instead of putting a percentage on that. If they give a formula, taking into account the cash available with the company at that point of time.
Very clear. The loan value. Only difficulty I have in this.
No, how much of that?
But what is the rate?
No, that should be 100%. But that amount will not be much. But the calculation of a recompense is very vague, and perhaps none of the bankers also know, none of the borrowers also know about it.
There is something in the works on that.
It's on the
It's a lot
works.
of clarity.
It creates a problem in the case of working capital,
I don't know what
where
has been your
the diminution only for 1 year is taken now. Working capital is a perpetual facility. One can argue that it should be taken for the entire period of the unit becoming viable.
I think that is fair enough. 1 year, even for term loan, it should be taken every year, yearly basis, rather than taking for 10 years NPV. Because when you take in 10 years NPV, it is implied that you are going to be in the CDR for 10 years. I think most of the good units which come out of CDR within 3 to 5 years time. So I think this diminution also can be on a yearly basis for all uniformly.
Well, sir, that I think we have discussed the larger issues as well as some operational issues. There are any questions from the audience? And please state from where you are, what's your name and where you are from, and you can name the member to whom the question is directed. Okay.
Yeah. One question here. I'm here, this side. Okay. My name is Vivek Joshi, and I'm from a private equity. I have a question on CDR, maybe for Mrs. Kumar or Mr. Anthony. On an average, there'll of course be a range. What is the quickest time that you have seen for a company to successfully come out of CDR? Once it's gone into CDR, it's done what is to be needed. Generally, what is the fastest time that it has been able to come out? That's one. And number two, if it is able to come out successfully, what are the prospects that down the line it can repeatedly take this protection if needed in future?
Sir Anthony?
See, it's very difficult to say what the fastest. If you say specific cases have come out within 2 years, within 3 years. Cases have come out. But at the same time, there are cases remaining in CDR for the last 10 years. In fact, I think they did an analysis. There are cases even for the last, ever since CDR started, there are some cases even today it's there. They are not. Many of them are doing very well. They want to be in CDR because there is a comfort of CDR. Because it's all, again, I know a particular case where it's in CDR, remaining in CDR, because it's very comfortable in CDR. You want any approval, there are 20 banks, so any approval under one roof, under one approval is come. So he's very comfortable, he doesn't want to get out of CDR. So, it depends. Even the case which I mentioned about the pharmaceutical unit, just 2 years or 3 years, maybe third year he will be out. And
even the steel companies, they came out.
Steel companies all came out. In fact, they remained just 2 to 3 years.
So,
and again, when they come again in problem, whether they can go back.
Yeah.
See, CDR doesn't put any restriction on that. Okay. Only it should not be termed as a second CDR when he is in CDR already, then he is doing well for some time. It happened in some of the sugar units. They were in CDR. They started doing very well. But sugar, there is a cycle of 2 to 3 years. 3 years, I believe sugar industry has a 3-year cycle. So when they were in CDR, they did very well. They were about to exit, then suddenly things have changed. Your cane price has gone up and things like that. So they wanted to do. Then specific permission of Reserve Bank was taken for a second restructuring when they were in CDR. If they are out of CDR, they came out of CDR after paying whatever recompense. I think in a difficult situation, they can go back again.
One small observation here. Actually, what happens is These are, scenarios where the interest rate is rising. Centrum research revealed that during the last 2 decades, 20 years, this rising interest scenario never lasted for more than 15 months. After that, it starts going down. That is the time when the economy improves, the businesses revive, and that is the time when the companies come out of CDR. It happened in the case of steel restructuring. They were all done in the year 2002-3, which was followed by better times, better this thing. At very low interest, they could refinance their CDR loan. Many of the companies could refinance their CDR loan at very low interest by going to other banks. So they repaid the loan to the earlier bank, which was contracted at 12%. Even under CDR, the rate of interest was 12% for them, and 8% on the foreign currency loan when the LIBOR was 4 or 4.25. They all agreed at that time. There was no other go, but it was with due respect, it was a package given by the finance secretary himself of the day, Mr. Narayanan. They agreed. They had no other go. In any case, what happens is the cycle takes care of it. The coming out of CDR, the economic cycle takes care of it, and the companies have to time it properly. They time it when the banks have the move to relend again and to see that the earlier loans are restructured. Any observation, madam? Any other question?
Yeah. Good afternoon. I'm Shilpa Anand. Here.
Okay.
I'm from Eastern Engineering Company. We are in the textile machinery and engineering space. I recently learned that, for example, in many of the Dutch banks, a horticulturist is part of the team that lends to the horticulture industry. This person works as a bridge between the lender and the borrower and understands the constraints of both. Do banks in India actively employ such domain specialists?
Do you call Centrum a domain specialist?
Sorry?
We can always engage a domain specialist and...
No, I'm sure you do, but I just want to know whether, because from what I have been hearing and my takeaway from this is that, the banks also often get caught out because they don't realize how deep in trouble a company is in, and then at the end of the day, they come and they find a huge problem. Whereas if they already had somebody in their team who knew the problems of a particular industry, maybe they'd be able to proactively, attend to the problem.
This is being done. This is actually being done during the period of, finalizing the final package. The banks do outsource viability study to domain experts. They do that.
State Bank of India, we do have our own technical consultancy cell also. And we have a panel of industry experts for various types of industry, the best in the industry. We have a panel of industry experts who are on a retainer basis. So whenever we need to make a reference, they are always available there. And they are the best in the country.
Yeah, this is Mani from SIDBI. This is in reference to a clarification made by Mr. Anthony for forming CDR cell by SIDBI. SIDBI should anchor it. And in fact, Mrs. Kumar was also saying that because it is single banker entrepreneur relationships, the CDR has not flowered in SME sector, basically because of huge informational asymmetry or trust deficit between the promoter and the banker. And Mr. Sankar has also said that his counseling services should be actually provided by the banker to SMEs. So in this August forum, I wanted to mention that SIDBI has already started 120 credit facilitation centers, which act as a bridge for this trust deficit between the promoter and SME, so that they will also work with these SME enterprises in case proactive or preventive steps are required to account slipping to NPA. So maybe in case if it succeeds, probably SIDBI can think of forming a separate CDR cell. Thank you.
Thank you.
This is Umesh Gure from Yes Bank. As far as CDR is concerned, what we have observed is the promoters who come to CDR, first thing, most of them don't think it is their problem, they think it is the lender's problem. And if the lenders want to recover their money, please restructure. Otherwise, there are lenders who have come to CDR and said, I'll hand over the keys, do whatever you all want. There is no disincentive for a promoter to come to CDR. It is the best option for him because he loses nothing. A promoter and a shareholder in the company are the highest risk takers, but they are the least guys who suffer in CDR. That is my first point. Second point is you mentioned some of the banks are not willing to, give additional funding. Yes Bank is definitely averse to giving additional funding, and there have been reasons and there has been history. In some of the cases, without quoting the name of the case, we had a derivative exposure. It got converted into a 1% preference shares redeemable in the year 9-10, whenever, after 9-10, 10th year. If money is not available, then from 11 to 15. How will that redemption happen? The promoter has to bring in around 350 crores. The promoter does not have the capacity to get even 40 crores, which is required as his contribution. How is, in 10 years, how is he supposed to earn 350 crores and redeem my preference shares? We raised these issues. Second point in the same case we raised is that post-restructuring, it is a listed entity. Post-restructuring, based on the financials which were submitted in CDR and in the package, post-restructuring, the return on equity was 10%. How come I'm, as a lender, getting only 1%? I'm being treated worse than an equity shareholder of the company. We raised this issue with the CDR-EG, with the lead bank, with the core group. Till date, we have no response. Second, in some other case, my loan, which was a term loan repayable in 6 months' time, gets stressed to repayable in 10 years. Okay. The lead banks or the top lenders' LC dues, which are falling in the next 6 months, they are paid as per, on the due dates. And I am net, if you see the package, net, all lenders are contributing for that payment. We raised this issue again with the lead bank, with the core group. It's 5 months, I have not got a response to this letter. Okay. So there are certain issues, as a minority lender, I have no say. Why should I, if nobody is going to hear, sometimes we have observed our views are not even recorded in the CDR-EG minutes. Why should we contribute?
I will take your last question first. Okay. The last question is, you said the LCs are being paid for the main banker, the lead bank, and you are denied the repayment and all. So as far as the non-fund based facilities are concerned, CDR circular is very clear. It says it should be on a risk sharing basis. That is, one bank will open the LC and the other banks have to share the risk in the same manner. So if your LC is not taken up on due date and the lead bank's LC is being paid, it is, I think, wrong in structuring. If you had gone by the CDR guidelines, you would not have suffered because it will all be pooled and shared. Okay? That is why CDR circular, if you read, especially the two, I said it is 66 pages. I think 66 pages was a wonderful message. I have never seen a circular giving so much flexibility in every area issued by CDR. It is a wonderful circular. In the true spirit, if the banks as well as the entrepreneurs follow this, I think CDR will be a wonderful mechanism. This is my personal view. Absolutely. Coming to your first point about the borrower coming and saying that throwing the key, and this posturing and arm twisting will go on until either party achieves his objective. Banker's objective is to keep the account afloat. His objective is to see that you do that. So for that he will posture. I think these are matters of friendship and dealings and relationships.
Is it possible that when a borrower comes to CDR, he deposits certain percentage of the total debt if he wants to get his case admitted also at the time of admission? Let him pay some money. And depending on the number of years of restructuring sought, that much higher the percentage of his contribution.
What could be that percentage?
No, that is up to...
No, why we are saying is, we are talking of situation when already the fellow is cash strapped.
No, he has to get promoter contribution. Let's not forget that RBI also says you have to get promoter contribution.
Any views, sir, on this?
No, promoter's contribution is stipulated. In fact, see, the company is stressed, that's why he's coming to CDR.
After the package, he says upfront to discourage.
Upfront, it may be difficult, but CDR has its own mechanism of stipulating some part of the promoter's contribution. But your point that your derivative gets 1% after 10 years and equity is 10%, perhaps I don't agree with that, because a case which is in CDR, he cannot declare dividend anyway until all the debts are paid. Okay? No, he can't declare dividend. That means the promoter. Now one thing what we look at only promoter. In some other cases, lakhs and lakhs of shareholders are there. They also take a sacrifice. their money is stuck. Along with the promoter money is stuck. Similarly, they also stuck. At least bankers get the interest. You can, as a shareholder, I can ask this. I mean, I'm not getting for the last 10 years, not even 1 rupee for dividend.
Yeah,
So, I mean, what I mean is dividend is not to be declared until your debt also is repaid.
So it's a listed entity, and the other lenders have converted substantial portion of their debt into equity. At least there is an exit option. All we were saying is, instead of these preference shares, give us equity.
Should be.
I mean, is there?
I think if you ask
not
for,
an unreasonable.
Should have been done at the time of finalizing the
I
package.
think you could have suggested that. They would have agreed.
No,
willingly agreed.
nobody agrees. All we hear is that everything is approved by super majority, so you have to fall in line. That's the only, and after writing to the CDR, EG, CDR, marking it to CDR core group, no response. In these two cases, absolutely no response. We also suggested that why can't we have, a representative of smaller lenders on the CDR EG panel? Because if you see the CDR entire forum, it's the top lenders. As far as the core group is concerned, EG is concerned, CDR cell is concerned, TRA bank is concerned, it's always the top lenders. Where is the say for the small, if it is a forum of all lenders together, there is no say a smaller lender has. So smaller banks why can't a smaller, let it be elected?
No,
Smaller bank, because I know where there are cases where SBI has been a minority.
No, in the overall spectrum.
And we have been forced to go along with the super majority. I'm not saying that it doesn't matter whether it is Kotak Bank or Yes Bank or SBI. If in that particular loan, your share is only 2% or 3%, then you are a small bank as far as that particular.
No, but overall, if we can have lenders, the top lenders sitting on the CDR EG panel in all cases, as you say, SBI might be a minority lender in a particular case, but still SBI is sitting on the CDR EG panel. So similarly, even if, there are certain smaller banks, who are part of the CDR mechanism, why not have one representative of the smaller banks? Because most of the cases, they are the smaller lenders or the minority lenders. Why can't we have one person sitting there so that the minority is not oppressed?
No. Let me.
One thing, I think if you look at history, what has happened is when the boom time in the economy was there, how did all these other banks get in? When these companies were doing well and there was boom in the economy, there was a consortium lender, and then you saw somebody from outside the consortium, somebody goes and gives 50 crores, somebody goes and gives 30 crores. Absolutely. And then finally, when now you have a situation like today, and there is a problem in the economy, then when it goes to CDR, these banks become minority lenders. I mean, at that particular point of time, those banks never thought that, okay, we will get into the consortium and be with the consortium. Even the approval of the existing bankers was not taken. I think yes, NOC has not been taken. Or you have a consortium, and then there is a lot of multiple banking outside the consortium, and this is why I said that transparency is required. The customer has a problem, he never tells us. He goes and borrows 50 crores from 10 different people, borrows 50 crores from somebody, pays off another loan, and then we have created this. We have to understand that we are all responsible for this, and then we have to work together to get out of it.
And just to add to her what we said, if you know the history of CDR, initially it was only 75% were the supermajority. When some of the minority lenders, they represented to us and CDR, and we took up with Reserve Bank of India that minorities' interest also should be protected. That's how the 60% by number, it came much later. That is only to take care of the smaller bankers also.
What is for the monitoring committee, there shall be a small
bank. Fair enough, this provision is there. But if you actually go through the packages, and when a minority lender is writing to the CDR EG and there is no response for 5 months, there is something seriously wrong. Because if there was no operation of minority lenders in that particular case, the response should have probably received in 15 days. It's 5 months.
Agreed.
And CDR EG or CDR core group just chooses not to respond. I mean, that is not acceptable.
No, perhaps you have not suggested at the CDR that you will convert yours into equity. I don't think CDR has any issue.
No, we have written letters, sir. Okay. Suggested, I mean, our suggestions don't get recorded also.
Agreed. Okay. There are issues.
See, another interesting thought on this issue of converting into equity. The general perception is if somebody converts debt into equity, that means he has overborrowed, therefore that portion is being carved out as a equity. Okay. Sustainable debt we keep, the rest we move to equity. Fine, at least one restructuring which I remember, which took place just before CDR came into being, the Mangalore refineries. When it was taken over, the Birlas sold it to ONGC. I think there was one consortium meeting where every banker smiled because they wanted those shares. And finally they sold at a premium and recovered much more than what they would have recovered, what they would have earned by way of interest. This is a fact. So there are such restructurings also which exist in the system.
Any other?
Anyone else?
There.
Rajiv Samant from power sector. When we are doing this CDR, are the bankers also interacting with the nodal agencies like the central CERC and all to understand what is the policy going to come, how the policy is going to affect the power sector? Are they doing adequate advocacy to understand what is the power purchase agreement? Are they also linking to it? Because what is happening is, because there is no link between that, your assets may become NPAs.
We do the sensitivity analysis. I think, this will all be factored in when a viability study, the appraisal is done by an outside consultant. A TEV study is always done. Most of the cases it is done. Of course, Mr. Anthony has a different view on the TEV study.
No, CDR, when you mention CDR, it's the same bank which has granted you loan. So they are aware of these issues, right?
No, but if it is happening after a considerable time and things, the environment has changed in the meantime.
Okay.
And if it necessitates study
See,
again,
this
we do get it
specifically
done by
came in morning because when the governor was deputy, he was speaking about the Indonesian mines and all that. You have to understand that when the power sector works in India, we are importing coal from outside. So if there is any change over there, it is going to affect. So an asset which is done with a very good intention will become an NPA if the banks also don't support.
when we do the risk matrix, we take all the
Such issues are in the realm of judgment. I think these are factored in by all the banks when they take a decision to restructure or not to restructure an account.
Just one question. Hello. Here.
Yeah.
I'm Praveen Sudka from a company in the construction sector, and I just heard one banker saying that the promoters are the person who suffers the least when the account go for restructuring. I think I would like to counter that. It's the promoter who suffers. I mean, promoters have no, I think, they just want to go for CDR just for the heck of it. Because of the circumstances, I think the SBI MD has rightly pointed out, it's because of the macroeconomic circumstances in the country at this point of time that most of the promoter has to refer to the CDR themselves. And the promoters also suffered a lot in the sense that they were supposed to give promoter contribution. The guy was now supposed to pledge all the shareholdings, and on top of it, now personal guarantees becoming mandatory almost. Now, there's a question of very clearly, on one hand, the company law gives a company protection clearly saying that it's a joint stock company and it's a limited company is a limited liability company. Now you are asking promoter to give him pledge his personal guarantees. It means asking the personal property of the company to pledge for the purpose of the company. I think it's legally incorrect. So I think this has to be taken into account, and asking the promoter every time that, okay, you give money up front, and unless the package will not be clear, and one hand you are taking entire promoter shareholding also as a pledge, from where the promoter will get the money.
How will you react to that, madam?
This is still in the recommendation. I don't want to comment on it because yesterday there was an IBA meeting. The bankers have given their views. So right now I don't think I'll comment on that.
No, one point what I would tell you is that in India, in Indian scenario, the promoters count a lot because they normally hold 50, 60, 70%. So they are the owners. So they have a responsibility towards the project. So I don't think there is anything wrong in the bank asking you to commit a little more. After all, it's a joint effort to revive the unit. And if the promoter is not convinced that this will not come up, then what you say is right. Banker should not ask. But if you are convinced as a promoter, I think you should be willing to give, no?
I think
because banker is normally 70-30 debt equity ratio. Is a 70% owner of the company or joint partner is asking for that. You are a 30% partner. I think it should not be a problem.
No, it should not be a problem, but I just, I don't want to say it, but I think by the same set of argument which you are just taking, I can also say in that case, shouldn't be asking the banker's chairman to also give personal guarantee for the loans which is restructuring? Because if you go with the same set of imagination.
You are changing.
So I'm not asking for it. I'm not asking for it.
No.
But because when
That's
you say
the thing,
it's
fair
partnership,
fair
when you are
enough.
giving loan, you are appraising the loan very clearly from day upfront. You are appraising the loan, and company has gone sick not because of the promoter's fault. It has gone sick for the part of the basically the macroeconomic conditions prevailing in the country. And suddenly you are asking promoters to put everything, his personal, everything onto the board for the purpose of restructuring. In that case, okay, let the chairman of the banker also put everything onto the board and say, okay, now let's revive the company.
No, this
Sorry, I don't want it, but
No,
I'm just saying the same argument.
Larger
Sorry.
issues.
See, I have seen cases where the promoter starts off some 35%, 40%, 50% shareholding, and in the when the times were good, they have benefited out of it. And over a period of time, when there is a problem, they've diluted their shareholding, or they create smaller companies, which then the shares are transferred to the companies. See, these kind of, so I think it's a case-to-case basis. We may have to look at it. Secondly, I can give you a very solid example where you're talking about promoter's guarantee, an account which was restructured in CDR. There was a proposal for appointing a new CEO with an exorbitant salary. And of course, rightly, I think CDR EG didn't approve that, but it turned out that who was the CEO? It's the wife of the promoter. I mean, you come across cases like this also, you know. So it's not, I think case to case you will have to look at it. But since it is already in discussion, I think we'll see.
Good afternoon. My name is Umesh Lathi from a corporate. I just strongly oppose the point which is raised by Yes Bank. This is not the way in which the promoters just hand over the keys. The promoters are the most sufferer, and bankers as such are also equally taking the stake as a finance partner into the business like the promoters. So that is number one point. And secondly, my question is to Mr. Anthony regarding the exit route of the CDR. If the company is viable enough and promoters are also willing to continue with the company and things are all okay, but this right of recompense is